Welcome to the Explainer. You know, when we talk about ESG investing, the E for environment and the G for governance seem to get all the headlines. But today, we're diving into the S, the social pillar. And we're not just talking about abstract ideas of doing good, we're going to connect the dots between social factors and what every investor really cares about: cold, hard financial risk.
So let's just get right to it with the big question. Can the way a company treats people, its workers, its customers, the communities around it, actually make a dent in its bottom line, and, by extension, your portfolio? Well, as we're about to see, the answer is a huge and increasingly measurable yes.
All right, to really get our heads around this, let's break down what we're even talking about. We'll kick things off with external social factors. Think of these as the ripple effects a company creates, the things that impact people outside the building, like local communities and customers. These issues might seem separate from day-to-day business, but trust me, their impact can be massive.
A really critical concept, especially for sectors like mining or energy, is something called free, prior, and informed consent. You'll hear it called FPIC. It's basically a non-negotiable rule of engagement. Before a company can even think about starting a project on ancestral lands, they have to get genuine consent from the indigenous communities there. And look, this isn't just some nice-to-have policy. It's a powerful way to avoid future conflicts, project shutdowns, and, frankly, huge financial losses.
And what's so smart about this is how these four pillars build on each other. Free just means no funny business, no pressure. Prior means you ask for permission before you show up with the bulldozers. Informed, now this one's key. It means you share everything, the good and the bad, in a way people can actually understand. And only then, after all that, can you get to real consent. It's a framework that protects everybody.
But of course, FPIC is just one piece of a much, much bigger puzzle. The world of external social factors is huge. We're talking about everything from stakeholder protests that halt a project in its tracks to finding out your products are being made with forced labor, or even something like animal welfare. You've got investor groups like FAIRR that are now zeroing in on the risks of antimicrobial resistance from factory farming. That's a social issue that has a direct line to public health and, you guessed it, corporate liability.
Okay, so there is a whole universe of potential social issues out there. So the big question for any investor is, how do you know which ones actually matter? Which ones are going to move the stock price? How do you separate the real financial risks from all the noise? Well, the answer, more and more, is coming from government regulation.
Yeah, the whole game is changing because governments are now stepping in. They're creating new rules that force companies to actually report on how they're doing, socially. And this isn't just about being transparent for the sake of it, it's about creating the hard data that investors need to actually compare companies and spot the risks that used to be hidden in plain sight. And we're seeing a couple of different approaches here. You've got things like the UK's Modern Slavery Act, which is all about process. It basically says, we're not expecting you to be perfect, but you have to tell us what you're doing to fix this problem. Then on the other side, you've got the EU taxonomy, which is all about performance. It sets these really clear lines and says, to be called sustainable, you must meet these specific social standards. Either way, both approaches are designed to help investors figure out who's really walking the walk.
All right, this is where the rubber really meets the road. We've talked about the ideas and the rules, but what does this look like in the real world? Let's walk through a case study to see exactly how a social issue, in this case equal pay, can become a gigantic, quantifiable financial risk that no investor can afford to ignore.
We're going to look at the huge UK supermarket chain Tesco. For years now, it's been tangled up in a massive legal fight over equal pay. And this whole dispute is a perfect example of that link between a social issue and real financial consequences. At its core is a very powerful claim about gender-based pay discrimination.
So here's the claim in a nutshell. The work done by store employees, who are mostly women, is of equal value to the work done in the distribution centers by staff who are mostly men. The problem? The lawsuit alleges the pay isn't equal. And this isn't just some bad press for the company. No, this is a formal legal challenge, backed by a specific law, the UK's Equality Act, and that gives it some serious teeth.
And the scale of this thing is just staggering. We are not talking about a couple of people. One of the main action groups represents about 8,000 current and former employees. Just let that number sink in for a second. Every single one of those people could be owed years of back pay. This is how you start to see a social issue morph into a potentially massive financial liability.
And this, right here, this is the legal firepower behind the whole thing. It's a direct quote from the law. This bit, Section 66,
is known as the Sex Equality Clause, and it's the foundation of the entire case. This is what transforms an ethical argument into a direct, legally enforceable, and very expensive financial risk for the company.
So here's the bottom line. An investor looking at Tesco can't just analyze sales and profit margins anymore. They have to factor in the very real risk of a potential multi-billion-dollar payout for back wages. This social issue has a direct, material, and massive impact on the company's valuation, which, of course, hits investor returns. This is the S in ESG made real. So, what's the big takeaway here? Well, understanding these social factors isn't just about ethics or feeling good anymore. It is now a crucial part of smart financial analysis. It's about spotting those billion-dollar risks that don't show up on a balance sheet, at least not yet. And as these issues become more visible and more expensive, the real question for you is no longer whether the companies you own are good, but whether they're prepared. So take a look at your portfolio. Are they?